This is Creator Finance, the only financial planning podcast built for creators by a creator. Here's what most financial advisors will tell you. Get a proper job with a steady income. Here's what I'll tell you. Being a creator or digital entrepreneur could make you wealthier than any 9 to 5, if you know what you're doing with your money. My name's George Agan, I'm a creator and chartered financial planner, and this is where creative freedom meets financial freedom. Welcome to Creator Finance, and this episode I'm going to be going into my 3 topics. I'm going to be going into markets. We've seen quite a bit happen in relation to the gold price this year, and I think it's really interesting and worth discussing. Warren Buffett has called it shiny, useless metal. However, it's been on an absolute tear with returns, depending on how you judge it, from 40, 50, 60% this year alone. So I'm going to be diving in the markets topic around the case for gold. I'm then going to be going to Investing 101 for creators and digital entrepreneurs. And the whole purpose of doing this is I want to really use it as a starting point, effectively, for somebody to kind of, if they're thinking about investing, there's a ton of personal finance content out there. But I think a lot of it maybe misses the clarity, bringing it all together, making it clear in a way that it's going to work best for digital entrepreneurs and creators. So I'm going to be doing that in the Investing 101 topic. And then finally, I'm going to be talking about British Airways and how they structure their tickets and why you need to be thinking about this with your business going forward. So let's go into market.
My question is, how do you time the big market moves so well?
We haven't the faintest idea what the stock market is going to do or timed anything.
So what on earth has been happening with gold? Well, depending on how you measure it, gold is up between 40, 50, even 70% depending on the particular fund. That's this year alone. It has been on an absolute tear. I should definitely say before I start diving into this that when we're going to talk about investing, this may not be right for you. So just bear in mind that everything I say is information only, not to be acted upon without advice. Please seek advice specific to you, all the regulation stuff that I've got to say. So why is this happening? Well, there's kind of 3 key reasons which the market believes are driving the gold price. It's important to say this is the consensus. Nobody actually ever really knows what drives markets. You can't ask the market what's going on, but we build theories, we build hypotheses, and that then, because we're storytelling animals as people, this then tends to be kind of reverberate across the markets. So one of the big areas of why gold has been up so much is central bank accumulation, basically central banks purchasing gold. So gold moved from 10 to 20% of global reserves in the best part of a decade. This was often driven by people like China, Russia, a lot of other BRICS countries. And the reason why they're doing it is they're wanting effectively to build in a reserve separate from this. So why is this happening? Well, there are China, Russia, other Silk Road nations. They are major buyers, and the amount they're buying in gold now exceeds Euro and US treasuries, reportedly. We'll never really know. Why are they doing this? Well, it kind of follows on to a bit of what's called a de-dollarization trend. Basically, the US, the dollar, is the reserve currency of the world. And that gives the US enormous economic and political power. They can ultimately constrain dollar supply, and it acts as an economic sanction. So if they're wanting to, I don't know, maybe, for example, put sanctions on someone like Venezuela, they can do that in an economic way as easily as they can do it in a military way, and that gives them enormous power. It's important to say that reserve currencies change over time. This goes all the way back to when the Dutch had a reserve currency. It was the Portuguese, the British. I think I've got the order right. I might have got it wrong. All I'm trying to say is that these kind of trends change over time, but they tend to change when there is a significant change in the world order. And if you are somebody who watches a lot of online content, which I can imagine you probably are, just bear in mind that there are a lot of finance content creators out there who their job is to oversell what is going on. Yes, we are seeing globally a pullback from people losing a bit of trust in the US dollar for various political reasons. But that does not mean that the US now is going to be, a minor power. They are still by a long, long way the global reserve currency. Now, the reason why this links into gold is because gold ultimately isn't somebody else's liability. If you think about the fact, if you earn dollar-denominated debt, or specifically US treasuries, which are basically IOUs from the US government, they are ultimately the US government's liability. And not that I'm saying that they would ever go against that liability, but you are making a bet that the person who has lent you that money is going to return you that money. And that's all well and good, apart from the time that there would be severe escalation. Because if you're in a position where, for example, there's conflict between those nations, those liabilities could become into question. Now, gold is different. Gold is quite literally a physical asset. And this also has linked in with a bit of a US policy shift. J.D. Vance called reserve status a tax on American producers. And this indicates that actually dollar decline or dollar depreciation, which can often mean gold does better, could actually be almost acceptable political policy at this moment in time. So they're the key narratives that are driving the gold run, and structurally you could argue could be a reason for it to continue. Now let's take a step back. Yes, gold is doing well at the moment, but why do we have anything within our portfolio? And I think this is a really important thing to ask yourself. Like, why am I holding this asset? Warren Buffett famously said that gold was shiny and useless. And he used to give an analogy about a farm. And he used to say, right, if you have, I don't know, $1 million worth of gold and $1 million worth of a farm, you can leave that $1 million worth of gold, you have a big pile of gold, and you could leave it in the ground. And in 100 years, you could go and dig it up, and it will be worth whatever the gold price is at that moment in time. However, if you take a farm, which is kind of his analogy for a business, that business is going to produce crops and wheat and all the rest of it in that 100-year period. They could have produced an absolute fortune off the back of the human ingenuity. And if you haven't guessed it, that is the analogy he's driving between the difference between owning businesses versus gold, which is just a non-income producing asset. And I think this is crucial that we're aware of this within portfolios. Yes, there are going to be periods where things like precious metals rally, but why specifically are we having these things in our portfolio? And let's just dive into some of the data. And my favorite paper on gold, and yes, I am nerdy enough to have a favorite paper on gold, is by a guy called Campbell Harvey, and it's called The Gold Dilemma. And it's actually quite a readable paper by academic data standards. And what he does is he goes through gold. Admittedly, it was done in 2011, 2012 now, so it's not going to be perfectly up to date. But he goes into it and looks at, right, why do people hold gold and what actually holds true in relation to the data? People say that they hold gold because it's an inflation hedge. It protects you against inflation. But actually, when he looks at it in the paper against historical standards, it's a really poor hedge against inflation. The price of gold versus inflation can be highly volatile. Another reason people say that they use gold is for a currency hedge. So basically, what that means is that you have it to protect against depreciation in your currency. But again, he found that with that, there is a small correlation, a small linkage there, but it's not sufficient to be like, yes, this is actually offering us portfolio protection against currency depreciation. So again, it kind of failed on that one when it looked at the historical standard. The other one is about being a safe haven. So this is one of the reasons why gold often is touted as doing really well, is because when economic conditions are bad, people, they say it's a flight to safety, a flight to things like gold and treasuries. And the reasoning behind it is because they are considered the ultimate safe asset. But actually, when they again looked at the data, about 17% of the full sample, both stocks and gold fell at the same time. So if you've got something which is there to protect in the down markets, and actually nearly 1/5 of the time it doesn't do that, can you really call it a true safe haven? So he then kind of unpacked those myths and, well, what does drive gold prices? And there's a huge demand dynamic. So if we think about it right now, that's playing out, isn't it? If central bankers are buying more gold, that's clearly going to drive gold prices up. Supply constraints can have a big impact. So, for example, about 76%, this was back when they did the paper, of achievable gold is already mined. However, this paper was done before there were significant strides in relation to doing it in labs. They can now create gold in labs. So that kind of area may have been a bit debunked. So where do I stand? Where should you stand? Well, I don't know where you should stand, but I'll tell you kind of my view. I personally don't hold any gold or don't plan to hold any gold in the portfolio. And it does come back to the Warren Buffettism. I'm not saying that's necessarily right for you. I'm just saying this is my opinion. And the reasoning behind it is just effectively is over a very long time horizon, the data is spotty at best in relation to what it actually produces. I mean, yeah, you could make the case that if the world goes to hell in a handcart, that you may be better in gold than in stocks. But if I'm being honest, if the world blows up, I'm not too sure anything in the capital market is going to be particularly helpful to you. So I'm just not convinced that something which doesn't produce any income, it's non-income producing, it's debatably good against inflation. What it tends to be is it tends to just be a signal from the market. There's some uncertainty and it doesn't meet the definition, in my view, of what a true investment is, which is it provides rising income and rising capital over time. You need both elements. You need something that will pay you more income to keep up with inflation and also will rise in price. It can rise in price because it pays you income, but ultimately you're trying to outrun inflation. And gold, as I've mentioned in the paper, is not fantastic at doing that over a short or human lifespan period of time. They did find in the paper that actually over thousands of years, it's quite a reliable protection against inflation. But sadly, neither me or you are going to be thousands of years old. So I'm not sure how helpful that is. So that is my take on gold, what you need to be aware of in the markets. Let's go on to the Creator Finance core topic, Investing 101 for creators and digital entrepreneurs. This I want to be used as something that you can go back to if you ever want to know why we're investing. And I'm going to take this from a brilliant company called Dimensional, and they told me about this when thinking about why do we invest. And it's called the 4 quadrants of wealth. Now, I appreciate some people are going to be listening to this, but I just want you to imagine 4 squares, 4 quadrants. And on those squares are written certain things: earn, spend, owe, and own. And they're written on each of the squares. So earn, spend, owe, and own. Now, very simply, why are we investing? Well, we're investing because one of these days, when that earn goes away, we need to make sure that what we own can cover what we spend minus what we owe. Now, ideally, we also don't want to owe anything. But these kind of 4 elements can tell you pretty much everything you need to know about personal finance and the dynamic around it. If you spend more than you earn, then you're going to be in a position where you don't own anything and you start owing things. Ultimately, these 4 elements of personal finance are the key things that we need to know going forward. And it boils down to one of these days, if we ever want the security of financial freedom, we want to be able to work on our own terms or maybe not at all, we need to make sure what we own, however we do this, whether it be our business, whether it be property, whether it be a pension, whether it be other investments, can cover what we spend. But we are not trying to attack something which is standing still. We are trying to achieve something which is a moving target. And that is inflation. Inflation is the reason why we invest. If you took £100 in 1990, you would need £254 today based on CPI, Consumer Price Index average inflation. That is 2.8% a year. So ultimately what that means is that over a 30-year time horizon, the money you have, if it doesn't keep up in line with inflation, if it gets eroded by inflation, will basically halve. That also is a lower measure of inflation than what's called retail price index, which factor in housing costs. Then that £100 would have turned into £346. And the difference in average inflation wasn't huge. We'd gone from 2.8 to 3.5. And the compounded impact over time of that small amount of increased inflation has had a huge impact on the purchasing power of our wealth. So the first message is all wealth has to be judged after inflation. The good news is that growth above inflation, in the same way that inflation compounding takes away from your wealth, growth above inflation compounds for it. And Warren Buffett himself, he accumulated 99% of his 100 billion plus wealth after age 50. And it's because compounding is a hockey stick. It starts out very incremental, the growth you get over time, but it has an enormous impact when we factor in 30, 40, 50 years. So the earlier that we can start, the better. Now, when we consider what assets are going to generate the best possible return over time in the most predictable way, there is no 2 ways about it. Equity markets, the stock market, has a proven track record since records began in financial markets of providing the most reliable, highest growth rate of return. So the highest post-inflation rate of return. If we look from inflation adjusted returns from 1900 to 2025. In the UK, that was about 5%. In the US, it was 6.5%. And the world, it was roughly around 5%. Now, that will naturally beg the question, why don't I just invest in a single geography? Like, why don't I just go big on the US or big on my market of choice? And the reason why we don't do that is because our time as humans is finite. We only have a certain period of time to get these returns. And the truth of the matter is, when you start looking at any of these individual markets, if you concentrate in a single country, there can be many years, decades of underperformance, which can have an enormous impact of where we get to financially. The great warning around this was around Japan. So the rise of the Japanese market would happen from 1970 to 1990. Japanese stocks achieved 22.2% annually. That's enormous, versus the rest of the world, which was about 11.5%. It actually got to a point that the Japanese market became 45% of the global market. Now, this then led to an enormous crash. If you had invested $1 in 1990, then you could get to 2025 today, and that $1 would only be worth $1.90. However, inflation over that time would be $2.54 compared to your $1. So had you remained invested in Japan and seen the rise and then remained invested across the fall, you would have lost money in real terms over a 35-year period. Meanwhile, the rest of the world, a globally diversified investment, would have that $1 would have turned into $22.94. So the lesson here is not that certain markets are going to be like Japan, because no one knows. And it's not and there were lots of structural reasons why one could argue that the Japanese situation was a one-off. But we have to take these lessons on board, that if you are concentrating in a single geography, you are taking an additional risk. People are talking a lot right now about US concentration in markets, and I'm not going to dive into that in this episode. I just want to say that if you are not globally diversified, history tells us there are significant warnings for that. And you only have one life. You only have decades to build your wealth, not hundreds of years. So in my opinion, you want to be doing everything you can to maximize the potential return that you have. So stocks, also known as equities, are basically a piece of ownership in a company. They are valued today. The stock price is based on the expected future profits of the business. You are ultimately buying an income stream in the future and some potential capital growth. Now you then become a shareholder. You own a share of the company. You participate in the ups and downs. If the company does well, you'll earn a higher return. If the company fails, you can lose your entire investment. Now, as I mentioned, stocks in aggregate have performed well historically. And the reason for that, there's lots of reasons, but I'll just give you a bit of an insight from one of the things that I think is often missed, is stocks do have an ability as an asset class to compound onto themselves. What do I mean by that? Well, let's say you have a company and that company produces a dividend. That dividend can then be reinvested by the company, which it can then use to re-expand its organization and grow. It has an ability to self-compound. It's what's called return on equity. And if it continues to do that over time, not only does the income have a chance of increasing in value, assuming it does, but also the pie, the size of the company, can increase. It has that self-reinforcing compounding mechanism. Other asset classes are not like that. If you have a bond, it is an IOU. The term is fixed income. The income is fixed. There's a bit of nuance here because you can get things like inflation increases, but we'll park that altogether. The whole point of that, though, is it's a fixed outcome. You don't have this self-compounding thing that's going on here. Even property, assuming it is a physical property, that doesn't self-compound on itself. You have rent and you have the value of the property. And yes, if you want to really pick hairs here in relation to that, you could use that money, reinvest it, refinance, buy more properties. We're not talking about the entrepreneurial venture of property. We're just saying purely as an asset class. That is one of the unique things about stocks that isn't necessarily the case. It's certainly not the case with precious metals. They're just precious metals. And that's one of the reasons why you get that additional return. The other element is risk. Now, if you are a shareholder, the company has the ability, but not the obligation to pay dividends. So let's say you're receiving an income from the company via dividends. The company, if it has a bad year, they can stop that at any time if the board agrees. Now, there's lots of mechanical things they have to do in order to do that. It would have an impact on the stock price. But there is a key thing you need to understand here is that dividends are not guaranteed. And if the company goes under, as a stockholder, as a shareholder, you may well get completely wiped out if you, for example, have all your investments certainly in a single company. Because shareholders, as far as when companies go under, they sit towards the back of the queue in relation to any assets that are left over in the company. Now, bonds are IOUs, so they are also called fixed income, as I said. They're a loan made to companies and governments. And instead of buying ownership, you are making a loan. Instead of being an owner, you are a loaner. And as part of that, that sounds really bad, but that's also how I feel about bonds. They promise to pay back with interest the amount of money that you have lent them. Now, unlike stocks, if the company performs better than expected, bonds don't change that much in value. That's just a liability. If the company performs not very well, bonds still don't change that much. Because ultimately, the bond is it's an obligation, it's a liability. The company can't default on their bondholders without significant consequences because they would be defaulting. Unlike the dividends, they can suspend dividends, and yes, that might impact the share price. Defaulting is much, much worse because there are legal implications. Even if a company goes bankrupt, bondholders can still often recoup some of the value, whereas stockholders get nothing. And government bonds, because they can often print more currency if they're in a position like the US are or the UK are where we can control currency, the chances of them defaulting is very low for that reason. There are various different types of bonds, and the price you get for bonds depends on the security of the issuer. So, for example, the US Treasury, because of the reasons I mentioned earlier, they're seen as very secure and you're not going to get quite as high an interest rate in general, versus if you were to have a bond of a very risky startup. This is also why there can often be a lot more volatility in stocks. Volatility is not an issue at all. It's a feature, not a bug of what stocks do. The stocks are the growth engine and the bonds are there to reduce the bumpiness of the ride. It doesn't always work, but that's what the bonds are there to do. They're there to provide some diversification in the portfolio. And I'm going to do a whole episode on risk and I think what the mistakes are on risk, but there is no such thing as no risk. There is only what risk and when to take it. Some people think about volatility, and actually the finance industry has considered volatility as the key measure of risk, and I've always thought it's wrong about that. Risk, is my view, is not volatility, because volatility over time often smooths out using history as all of our guide. But the real risk is not meeting your goals. The real risk is having one life and then not building your wealth sufficiently that you can ever live it. So I believe you should be really asking yourselves, what risks are you comfortable to take and how can you control that time horizon of your investment? Because if you can have a longer time horizon on your investment, the probability of getting a better return increases substantially, certainly in stocks. Okay, so we talked about asset classes, we talked about the dangers of being in a single country. Now let's talk about the dangers of being in a single stock. So the seminal work on this was by a guy called Henrik Bessenbinder. And he found through his research that basically that a very small proportion of stocks actually drives the entire return of the market. So you may have heard of index like the FTSE 100, which is the largest 100 UK companies, or the S&P 500, the largest 500 companies in the US. Well, actually, when people say that these indexes, which is what they are a collection of the biggest companies in that particular market, when that pushes forward, when it gets that return, all of the data shows us it's actually only a small percentage of those stocks. So Bessenbinder in his famous study, Do Stocks Outperform Treasury Bills? Treasury bills are IOUs from the US government. They used 26,000 US stocks from 1926 to 2016. So they've got a huge sample size over a huge amount of time. And what they found when they looked at all those stocks, that 58% of all stocks underperformed 1 month treasury bills over that lifetime. So just to really double click on what I'm saying here, when they looked at thousands of stocks over an enormous period of time, 58% of those stocks underperformed what was considered a very short term, very, very low risk bond. In fact, when they looked at the median return, so a slightly different measure of average, they found the median stock return was minus 3.7%. Most individual stocks in that market were losers. But when they looked at what actually driven the return of the aggregation of all those stocks, 4% of those stocks created all the net wealth they defined it as, which was the difference between what the treasury bills, the very low risk bonds, had generated versus the stocks. So this comes back to the famous founder from Vanguard, Jack or John Bogle, referred to different names sometimes. You want to pick the haystack, not the needle. Because if you are trying to bet your entire financial future on picking the right stock, yes, you might get lucky. You might be that person who ultimately predicted that Nvidia would take over the market, or you might be that person who's just got really lucky and can flout it then all over social media. But statistically, you are much more likely to be the person that gets it wrong. And if you're not in those 4% of stocks, or in a way which is diversified, which is where index investing comes in, you could be in a position where the market in aggregate does very well, but you fail to meet your objectives because the vast majority of individual stocks destroy value. Let me show you an example of Nvidia here on the screen. So if anyone's just listening, this is a screen which is up and to the right. Actually, it's not Nvidia, it's Build-A-Bear Workshop, as in the place that you build bears for kids. That stock is one of the best performing stocks in the US market. Isn't that crazy? I bet everyone's talking about Nvidia and Apple and all the rest of it. Build-A-Bear absolutely smashed it. Let me show you another one. This is the UK market. Who do you think this is? Well, it's Games Workshop, that thing which losers buy Warcraft from. Sorry if anyone's a Warcraft fan. That is one of the best performing stocks in the London market. Quick question, do you know your actual profit margin right now? Not revenue, your actual profit. If you hesitated, you're not alone. A lot of the creators I speak to who are earning 6, maybe even 7 figures aren't quite sure on this. But here's the thing, you can't build wealth on numbers you don't understand. That's why I put together the Creator Wealth Blueprint. It shows you every step on your creator journey, including your business finances and your personal finances, and exactly what to focus on so you can make the most of your journey, saving taxes and get financial peace of mind. Link in the description or the QR code here. How many of you had either heard of those companies or would say that they'd performed better than, I don't know if they've done better than Nvidia, but they've done better than a lot of the Magnificent Seven? What does this mean from your standpoint? Well, if professional fund managers, some of the most resourced people in the world with teams of analysts, can't consistently pick winning stocks, it's probably a fool's errand to do it yourself. You are often much better to just buy the whole haystack, as in a global index fund, because then you are guaranteed to own the 4% that we hope will drive the market forward. And this now, let's come on to active management. So what is the difference between active and passive? Now, I hate these phrases because the phrases are wrong. There is no such thing as pure passive and there is no such thing as pure active. But let's talk them in broad terms. Active management uses using knowledge and information to try and beat the market, resulting in a performance which is better than the general market. It involves predicting what market participants and stocks will do well, when to get in and out of markets, all the rest of it. Now, the evidence is that this doesn't work. Famously, Eugene Farmer, Nobel Prize winner in economics, came up with the efficient market hypothesis. And the market's main function is to aggregate all available information, including expectations about the future, make predictions based on buyers and sellers at all times. And when you see the price of a stock, it's not to say it's right, it's that is the best guess from the market. Now, does that mean that it's always rational? Does that mean it's always right? No. It's more about the flip side, which is that, is it so far wrong that somebody who charges higher fees can beat what all the aggregate participants in the market believe is the correct price? And there will be many people who argue very differently on that. But the truth is, active management has a terrible, terrible track record. Only a very small percentage of professional managers actively outperform the market. Those who outperform over a 1, 2 or 3 year period rarely outperform over future periods. There is huge survivorship bias. In any 10-year period, less than half of actively managed funds survive. The rest of them, which is a real issue with the industry, the fund management industry, they just close the ones that have done crap or merge them and then tout the ones that have done well as if they'd started the race all together and are all still on the track, when they're not. They've just subbed the underperformers or merged them. So there is this survivorship bias where some fund houses look much better than they were in reality. It's the same dynamic, which is why most individual investors fail to pick stocks well. The alternative is investing in a range of indexes. So the ones I've mentioned are the FTSE 100, FTSE All Share, the US has the S&P 500. These indexes are market capitalization weighted. So what that means is that larger companies get a larger weight in the index. The market pricing machine assigns a value to the companies based on expected future profits, riskiness and behavior relative to other stocks. More profitable, less risky companies, in theory, become more valuable over time, earning a larger weight in the market. Does this mean that they are perfect, that they're not flawed, that they're not subject to things that people in hindsight will say are bubbles? No, not at all. This requires huge precision in hindsight that no one human has. It's just that market cap weighted index funds are a decent starting point based on the evidence of how to invest. An index itself isn't an investment. You can't invest into an index. You can only invest into a fund that tracks the index. The key difference is often that index funds won't have this active play which can go right or wrong, and often will be much lower in cost. Once we've done that, once we have our investment thesis, we need to understand what risks are we willing to take. Now, if you're going to be a stock investor, you're going to have to deal with much deeper and potentially longer declines. As far as recent stock market history, we've only seen stock market drops which have been a couple of months, very max over 1.5 years. However, when we look historically, for example, to times like the dot-com bubble in the early 2000s or the 1970s, it is very normal and to be expected that the market will decline for a 2-3 year period, maybe more. There are no guarantees about the future, and there are no guarantees with investing. And if you are going to invest, you need to firstly have a good look in the mirror and make sure that you are truly comfortable with stomaching that volatility. The good news is that using all of history as our guide, is that if you can stay on the right side of that, if you can maintain discipline during the times of market declines, then stock markets have been predictably the best way to generate long-term wealth. So let's bring this back to digital entrepreneurs and creators. My view is, with your investment thesis, you need to ask yourself the question of your time horizon, and then what risks are you willing to take? It's my opinion that you should invest heavily and aggressively in things that you have a natural edge on. So if you can invest that money and increase the income from your business, if you have an edge in whatever your market is, then you should always back yourself. However, we want to have a barbell strategy, which is that we have one side of the weight which is aggressive around our own lives, the things that we can control, the things that we have edges in, versus we also have a family fortress where we build something that can provide capital which makes money in our sleep, ideally. This is going to be tax efficient, and we're going to see some ups and downs alongside with this, but it's ultimately to provide us that additional inflation beating return over the long term. So I hope that was useful. That was a primer on Investing 101, why we invest in the first place, how the real risk is not volatility in my view, but not meeting your goals, that you need to go in eyes open in relation to, if you are a stock investor, that you need to be willing to see every so often 20-30% declines that can last 2-3 years using all market data. But on the other side of that, they are the most reliable way to build wealth. In doing this, we have to be very mindful to avoid expensive mistakes. There is what's called the behavior gap, which is the gap between the investment returns versus the investor returns. This has been picked up in lots of studies. The Dalbar study, famously, which they had a look at the S&P 500 return, which was 10.65 annually across this point, but the average investor was 4.25. That means that the gap, the difference between what investments made versus what investors received, was 6.4%, and that was destroyed by poor behavior. This can be buying and selling at the wrong time, for maybe buying individual stocks and not getting the return of the markets, moving away from an evidence-based approach. All these things can have a huge cost over time. And it's my hope with the podcast that I'll do everything I can to make sure that you'll avoid expensive mistakes. So let's move on to the wealth wisdom topic. So the wealth wisdom topic for today is called the price of the ticket. And it is just it's a short conceptual point. And on the screen now, you will see a British Airways ticket. And if you don't know, British Airways is famous for having one of the best pension schemes in the UK. It's actually been joked sometimes that it's not an airline, but it's a pension scheme flying. And the whole thing behind that is it had enormous pension liabilities for these very generous, what's called final salary defined benefit schemes. So unlike plebs like me, these schemes who have like what's called a money purchase pot, where you get a pot of money and that then has to last you in retirement, these schemes ultimately provided a defined benefit, a guaranteed income for pilots who are on really substantial money for the rest of their life. I've actually done a lot of advice with the British Airways scheme, what's called the NAPS scheme. Anyway, when you buy a ticket from British Airways, within the price of that ticket, they have already factored in those liabilities. It is within every single ticket, every single purchase that you make through British Airways, they are factoring in now, carrying those liabilities, the liabilities of their pilots, of their staff, and their future, because within that is their retirement income. It is the day where the hard work of multi-decades of flying around is then recouped, and that person hopefully can have a long and happy retirement. The question you've got to ask yourself is, when you're setting up your business, and I think this is especially important for digital entrepreneurs and creators, are you including the cost of your future in the ticket? Because there are so many that I speak to and I see where we're not doing that. We're factoring in the cost of your current lifestyle. We're looking at maybe the things you want to do, and all these things are great. But as part of working, going back to that 4 wealth quadrant, own, owe, spend, earn, not quite got the order right. We need to make sure that within the price of everything you do, we are factoring in a future day of financial freedom. That is the reason why you get out of bed in the morning, and it should be in the cost of the ticket, whether that's the cost of your course, whether that's the cost of your business, however your business is structured. You need to be thinking about not only how am I getting paid, but how is my future self getting paid. I hope that's given you something to think about. Thanks so much for listening, and I hope to see you on the next episode.